Welcome back. After a few weeks, we learn about the personal finance. Now we will start about a financial market. The market participant. Who does what? How issuer, investor, intermediary, and regulator interact to keep capital flowing. This four participant is the most important knowledge if you like to invest in the cash flow capitals. The big pictures. Four roles keep capital moving from saver to the economy. The investor place saving into the market. The intermediaries execute order and connect flow. The issuer raise capital for the project, and the regulator oversee all three. Authorities such as AMF monitor conduct and enforce the rule of the game. Capital flow is one direction, oversight flow over everyone. Let's take an explanation one by one for the four role kept by our four entities. The issuer, states and company seeking capitals. The government and states issue sovereign bonds to fund the public spending, finance infrastructure, deficit and public service. Example government treasury bond, municipal debt. Companies issue share equity or corporate bond debt, raise a fund to invest, expand or refinance. Access market via IPOs or follow-on offering. The bottom line is issuers are the demand side of a capital. They need funding to grow or to operate. I know you understand it. If you have your company and you need the money, you are a part of a issuer. You must make a demand, a fundraising to invest your projects. Let's see the other side. The investor, those who put their saving to work. In this part is from you who like to invest in a bourse or you to invest in the capital of the industry. This is your part. The institutional investor, pension fund, mutual fund, insurance company, and bank manage large pool of capital professionally, move market through their sales of their trades. Retail investor, individual investing, personal saving, access market directly or through fund, smaller trader, but numerous and diverse. The bottom line is investors are the supply side of a capital. They seek a return on their saving. If you analyze the technique used by the government is the issuer. So to have a money to make the government continue to her activities, he used a pension fund by the by the enterprise inside of the state to invest in his building, in his school, in all their infrastructure. So if you work, you are like an investor in the government. And after you are don't work, you need your compensation. You take your return of the state investments. The third party is the intermediary, the connector between issuer and investor. What is the intermediary? In the language you hear every day about traders. The trader is the person who charges an investor to using his money in the issuer. Broker and bank, what they do, execute buy and sell order on behalf of clients, provide access to exchange and trading venues, offer advice, custody and settlement service, earn commission or spread for their service. The bottom line, intermediaries make more liquid without them. Buyer and seller rarely meet directly. Let's take an example. An example, I have an industry of medicine and I would like to get an investment and fund to build my company, for example, to protect the person of the virus. And if I have the company who make me to get the fund, the person who make me to get the fund is the intermediary because the intermediary charge the investor to use their money in my companies. That is a simple example to have a knowledge about intermediaries. Let's continue. The latest part is the regulators, the guardian of a fair and orderly market. The regulators set the rules, establish regulation for transparency and conduct, enforce compliance, investigate breach and sanction violations, protect investor, guard against fraud, manipulation and abuse. Example AMF in French, Autorité des marchés financiers overseas. French financial markets, licensed intermediary, and monitor listed company for compliant, transparent disclosures. The bottom of line is regulators keep the game fair. No market can function long without a juice. Let's take an example to explain the regulators. A regulator is like if you already see the football match, already see the football match. The football match is like an issuer, and the spectator is the the investor. The intermediary is the person who prepare the competition, like a FIFA, like UEFA, like a CONMEBOL, like a CAF. There is many more. And what is the regulator? The regulator is the arbiter who lead the match. Because if we don't have an arbiter, all the staff in the other side of the teams can do over what he like to do. But if the staff arbitral present, the regulator is present. So the regulator assure all the flow is work perfectly, all the flow is respect the rules. That is some of examples. And to finish your lesson today, let's put it all together. Issuer need a capital, investor supply capital, intermediary connect the two, the issuer and investor, and the regulator ensure trust and fairness in the issuer and investors. Together, these four rules from the ecosystem that channel saving into a productive investment efficiency and under supervisions. That is the lesson for today, and I hope to see you tomorrow to talk about another things in the financial market. Thank you very much, and if you have a question, don't hesitate to write in the comment. See you soon.